And welcome back to Mortgage Talk with Mark. I am your host, Mark Hairston, and my company is Texas Mortgage Source. We've been providing mortgage services around Central Texas for a long, long time, maybe longer than I'd like to remember. And currently, I'm the acting senior home equity advisor with Texas Mortgage Source because we are moving a portion of our efforts, a big portion of our efforts now into the reverse mortgage market. And that's an area which a lot of people aren't aware of. I started studying this market a couple of years ago. I am officially a senior. A senior, at least in this world, is considered over 62 years old, which I met a few years ago. And so I was talking to the program manager here at the station this morning before the show, named David, and we got on the subject of perception. And perception is a word that can be used in any genre, politics or religion or music or whatever it is. And I was thinking about that as far as reverse mortgages, because there's a perception that's been around for a long time, for a few decades probably, that reverse mortgages are a bad thing, that they're not right for most people. And I would have to argue with that point. I'm going to make some points around here today because I'm finishing up a book. I'm very excited about a book I started about 6 months ago on this subject. And it's not what I'd call a technical book. It's not about the program itself or the loan itself behind the scenes. It's more or less some questions that more or less people will ask about a reverse mortgage, including myself. I did a lot of research on it. I don't have one currently, but I'm thinking about getting one on one of my properties I own. And so I want to share some of these questions from this book. It should be out this summer, so I'll let you know about that. And it's called, I don't have the title yet, but I'm thinking it's going to be called Texas Gold, The Fortune in Your Backyard. So put in the comments below, what do you think about that? But in the meantime, I want to kind of talk about the perception of reverse mortgages, and not to argue it so much, but just kind of educate people on what it is. And so one of the questions I have in the top of chapter 1 is, why do older homeowners often underestimate the role of their home can be in retirement? And I think that's a mentality, and I've always thought the same way. My father grew up in the Depression. My parents grew up were Depression babies, and we were always taught to be out of debt. You know, that being in debt was a bad thing. Now, the fact of the matter is, most seniors over 62 who move into retirement age, which would be, 60s and maybe early 70s, about 3 out of 4 still have a mortgage on their home. They may have a lot of equity, but they still have a mortgage on their home. So they're not quite out of debt. And we can show them strategies around either removing that mortgage payment from their, monthly obligations, and creating a line of credit to access more capital, more equity in their home. Because the fact of the matter is that a lot of properties, and I mentioned this last week on the show, it's an astounding number. It's an astounding number that estimated 12 to 14 trillion dollars, trillion with a T, of equity is held under with seniors right now. And 88% of seniors own their home, which is also an astounding number. And so some people, a lot of people, certainly in Central Texas and Austin proper, or Marble Falls, or, Sun City or whatever, have 300, $500,000, $1 million worth of equity. And it's what I call debt equity. It's just sitting there. It's not doing anything for them. It's not enhancing their lifestyle. Even if they still making a small mortgage payment, it's just sitting there. So we have strategies around how to leverage that equity to create a monthly income, to create a line of credit, to pay off the current mortgage. Lots and lots of reasons you may want to use that equity. So that's part of the reason, because most of it's been around mindset, and we're sort of shifting that. Now, I will say that, having said that, this loan is not for everybody. Not everybody should be getting a reverse mortgage. And let's talk about that right now, as a matter of fact, because that comes up a lot. I personally believe that it's probably good for most seniors, at least to look at it, to ask questions around it, to run some numbers around it, to think about long-term planning, retirement planning, healthcare planning, all sorts of things like that. But the folks who probably don't want this product, okay, is folks who are going to be selling a home in the near future, in the next 2 or 3, 4 years, because the cost structure of a reverse mortgage would make that probably a poor decision if you're going to be moving. Now, if you're going to be in a home long term and you're a senior, this is your last home, One of my clients said she was in her 80s, but she said, "Mark, they're going to carry me out of here in a box." Okay, meaning that she was going to hopefully die in her own home. That was her goal. So, but not everybody's like that. But if this is going to be your last home and you're a senior with a lot of equity, you certainly want to look at it. The other type of person who shouldn't get this loan is somebody who can't make, if you will, uh, monthly obligations. In other words, when you have a reverse mortgage, it takes away the monthly mortgage payment, or there's no mortgage payment required on the loan, but you still are responsible for monthly, what they call property charges like taxes and insurance and HOA dues, flood insurance, if you had flood insurance. So all those continuing obligations have to be paid, just like they would if the home were free and clear with no mortgage. You still have to pay your property taxes, or they'll come and file a lien on it and foreclose on you. So again, a reverse mortgage in itself is not a risky thing. You know, I've said this before many times, but I love this line. I learned it from another speaker, and he said, what's riskier, having a mortgage that you have to pay back every month, or having a mortgage where they give you the option of paying it back? Okay, well, there's a lot of reasons to get a reverse mortgage, and that's one of them. It's an optional payment. So in outside of any sort of jargon, what is a reverse mortgage? Okay, a reverse mortgage by definition is a mortgage. That's what it is. I mean, it's a loan, it's a lien against your property. It'll be filed with the county. It'll show up as a lien. There's nothing mysterious about it. There's nothing really secretive about it. It's just a mortgage that works in reverse. That if you were to take out a $100,000 reverse mortgage, the interest rate right now is 6.5% to 7% on these loans as an average. It fluctuates, of course, monthly. That the interest will be accrued unless you make the payment. So next year, if the rates are 7%, you have a $100,000 mortgage, reverse mortgage, your loan balance will go to 107. The next year, 114, the next year, 122, or whatever. It keeps going up every year. So, but again, you defer any payments you're making currently. Like right now, I have a mortgage payment of around $2,500 on one of my properties. Okay, I owe about $250,000 total on that property. Let's say it's worth $1 million. If I got a reverse mortgage on that, I could live there and not make that $2,500 a month payment. Now, obviously, the more it wouldn't pay down like it is currently, it would be going up, but it would relieve me of that $2,500, which makes a big difference in most people's lives if they're retired. So that's just one brief example. There's hundreds and hundreds or thousands actually examples. Every client's a little bit different. So I wrote a loan last week for a guy who owns a home. He's got a $60,000 mortgage, not very much. His property's worth around 400, but he says, "Mark, I'm just tired of making this payment." He said, "I could pay it off. I've got the money. I don't have a lot of money saved up. I got a couple $100,000 in the stock market. I could pay this mortgage off, but I want to keep that money working for me." So the solution for him was to get a reverse mortgage, pay off the mortgage, and he doesn't have that $600 obligation anymore, which is a big deal for him because he has Social Security and some other investments, a little bit of other income. He's very frugal, very conservative, but he said, I want to free up the $600 a month to go to dinner or whatever he wants to do. So that was a good solution for him. And there's a lot of people like that. There's millions of people actually. So what's one of the biggest misconceptions people have? Okay, we talked about this a little bit last week, but probably the biggest misconception, and this is huge, is the bank takes title to your home. Okay, and that's not the way it is. I'm not sure where that came around because these loans have been available. Actually, the first reverse mortgages were from the early 60s, 1960s. There was a bank in Seattle that provided the first one. It wasn't an insured loan like it is now. These loans are insured by the federal government, which means there are certain reasons that you pay a premium for insurance. I'll talk about that here if I have time. But the first reverse was done in the 60s. It was actually in the legislation through Reagan's years in 1988. Ronald Reagan signed into law this idea of a reverse mortgage, and FHA is involved, which is the Federal Housing Administration, which is the Department of Housing and Urban Development. And so these loans are highly regulated, and there's no reason to be afraid of them. Okay. But somewhere along the lines, there was this misconception that the bank takes title, and that's simply not true. The owner still has title. It's just like a mortgage. If you have a mortgage on your house, you still have title to it, and you can dispose of the property as you choose. You can't give it away. You can't gift your home away with a reverse like you could if you had a mortgage. You could give away the property if you wanted to. You can't do that here. But what you can do, you can sell the home or you can refinance the home. And so the reverse mortgage has certain advantages of other mortgages. Okay. People talk about the cost of these loans. And I say it costs it relative to what? In order to make an argument about being expensive, it has to be relative to something. In other words, if you were to buy a Mercedes over a Toyota, you say, well, that Mercedes is expensive. Well, relative to a Toyota it is, but you have to look at the value that you're getting for your money. There is no other product like a reverse, and you can't compare it like that. You can't compare it to be expensive against what? There's nothing else that exists like this. So that's probably the biggest misconception is that your bank takes the title to your home, and it's simply not true. Now, the other bigger misconception, or one of the bigger misconceptions, is your heirs, once you pass away, or let's just assume you have a reverse and you pass away at 90, and your reverse mortgage, because the accrued interest over the last 20 years, as an example, is more than what you owe is more than what the property is worth. Let's say you owe $1 million and your house is worth 800 at the time. The $200,000 spread is forgivable by the government. That's why you pay an insurance premium. So your heirs would never be liable for any debt incurred if they inherit a property, I should say, that has a reverse mortgage. On the flip side, most likely because of the regulations of the federal government on who qualifies for these loans, most likely you're still going to have quite a bit of equity because of appreciation. You know, the normal appreciation around the country over the last 40 years is around 3 to 4%. Now that changes. It's like the stock market. It doesn't always go up. You know, in Austin, it's gone way up and it's come down. But overall, our appreciation is around 3 to 4% historically. So there's really no reason to think that's going to change much. Now, we could stay flat for a long time. I think we will stay flat. I think we're in 2026. I think for the next couple of years, we'll see minor appreciation in most areas. Some areas maybe more, and some areas maybe even more depression on values. So again, it's not an exact science. We can only speculate on the future, but generally speaking, properties appreciate. You know, I bought several homes in Austin. The first one was in 1990 for $90,000. That property today is probably worth $600,000. I don't own it any longer, but it's approximate value. So let's talk about aging in place, because this is probably the biggest one. My wife and I, we want to focus our efforts in the senior market. We've learned a lot about seniors because we're one of them. We've had parents that are seniors. My parents have passed. But we're in the past have been in that sandwich generation where you have children you're raising possibly, but you're also taking care of your parents. I have some friends named Mike and Kim Barnes. You may want to look them up. Mike and Kim own a company called Parenting Aging Parents. They've actually been guests on my show. I'm going to have them back because we're doing a class with them right now on all the variables and all the things you should be looking at when it comes to taking care of aging parents, possibly, or aging relatives or aging siblings or whatever. And there's so many different variables. It's quite amazing. There's so many layers of what you need to know. And they're somewhat what I call experts. They are not experts in reverse mortgage, but they are experts in other things that you need to take as far as legal and financial and things like that. But one of the considerations that they see a lot of with older people, and I have too in my years doing loans, even with my own mother, was they want to age in place. They don't want to go to retirement home, most of them. Now, some people want to be in assisted living, or not assisted living, what they call independent living. They like the lifestyle because they're around other people. But some people want to stay at home. They've been there 30 years. They may need some skilled nursing to come in the house. Okay. And the one way to afford that is a reverse mortgage. You can get paid monthly, or you can take a lump sum, or you can get a line of credit that grows over time. So you'll have access to money. A buddy of mine's mother-in-law, I should say, recently passed. She lived in Houston. She was, financially fine. They had a lot of money. But he said for the last year, she was at home and she was 94, I think, and she still lived at home and she had 24-hour care. It was $25,000 a month. Now they were able to afford it, but most people can't afford that sort of care. But that's the sort of thing where a reverse mortgage, if she would have had one, she could use her equity out of her home, which was worth a couple $1,000,000, in order to pay for that over the last year, which was 300 grand. Okay, 25 times 12 is $300,000. We don't have, most people don't have that laying around. Now that may be the exception, but that would be a case where a reverse mortgage may come into play for long-term care, or not long-term care, but nursing, skilled nursing, or home health care. And so, but there are some what I call emotional reasons. Most people are scared of these because, again, psychologically and emotionally, they were taught either by their parents or just through society that debt is bad, that you shouldn't have debt. And maybe that's the case. Maybe it's just psychologically not good, because every month you're going to get that statement. You're going to you're going to see the loan balance going up unless you've made a payment on that. So if that's going to concern you, then obviously a reverse mortgage is probably not if you can't sleep at night, then don't get this loan. So what does it really mean? Another question in my book is, what does it really mean when there's no monthly payment required? Okay. When we're talking about no mortgage payment, we're simply talking about a payment on a mortgage. Okay. Like I told you a minute ago, my $2,500 a month for my mortgage on one of my properties is just to pay the loan. Okay. Now, in addition to that, I've got tax and insurance and all the things and upkeep, of course. So the reverse mortgage does not take away those obligations. Now, there is a strategy that all lenders will use in the reverse mortgage space called a LISA, which is a life expectancy set aside, which means if you're 70 and you have enough equity and you don't want to make any tax payments or insurance payments in the future, they will set aside out of your line of credit enough money that every year the lender will pay those for you, kind of like a forced escrow account that you may have on your current home now, where every month you're putting in the money monthly in order for the lender to pay your taxes at the end of the year and your insurance as it comes due. That's called an escrow account. Now, reverse mortgages don't have an escrow account per se, but they do have a strategy if you qualify and there's enough equity that you can put aside, the lender will put aside, let's say 15 years of your tax and insurance. So they'll pay them for you. So you actually don't make a payment at all. Okay. And a lot of people like that because they know they're on fixed income, that they don't have to worry about that. And of course, if you sell that property, that money is yours. That set aside, if you will, is yours. Whatever's left over will be free funded to you. It's not gone. Okay. And so what happens, another area that we work a lot in is what they call, unfortunately, it's not just senior divorce, but let's talk about senior divorce, because there's a lot of people who, and they say this, and I haven't really done the research on it, but they say that the senior divorce is the largest segment of the population that's getting divorced as far as percentage. And that's really sad, but apparently it's true. And I've done some loans for couples who've been married, one married 35 years, 36 years actually. And they got divorced in their mid 60s. They've been married since they were late 20s, and raised their kids and empty nesters, and they just decide to go their own way for whatever reason. But they have assets they've built together, and by law, community property, especially in real estate, says, one party who's leaving the property gets half the property, half the value. And so the way they normally do that would be to sell the property and split it. But a lot of times they've been there several years and they like their home, or one party wants to stay there, then if they don't have the money to pay off the other person, they can get a reverse mortgage to help settle that settlement with, by law. And usually the judge will give you, 6 months or a year to make good on it. And if they can't put the money together, or they don't want to sell, if they could sell, of course, that may be the last resort to sell, as a matter of fact. But if it's not that they qualify for reverse mortgage, that's a win-win. They keep the house, one party, and the other party gets their money, and they go on about their business. And so another question I propose is why should attorneys, mediators, or financial advisors understand about reverse? Because it's it's been over the years sort of a subculture. It hasn't been top of mind for a lot of people. So a lot of times when you go to an attorney for a divorce, they have no idea about reverse mortgage. They don't know even to be an option. If you're a financial planner, most of them don't know anything about reverse mortgages either. They don't see yet because they're not educated. My job is part of my job, I guess, is to put it out there and educate folks on what this option is for a lot of people, because a financial planner financial planner's job is to plan your future, and part of that is retirement planning. What are we going to do what's our exit strategy from work? Okay. And most of them have not looked into or studied or cared about reverse mortgages, but 55% of seniors net worth is in their equity in their homes. And that's across the board. That's not just in Texas. That's a national stat that 55% of somebody's net worth is in their real estate, primarily in their primary home that they may have worked hard to pay off or pay down. And so our job is to educate financial planners and attorneys, possibly divorce attorneys, on this option so they can better educate their borrowers on how to live better. So here's another one that I'm going to actually be teaching some classes to real estate agents, because this is another area of reverse that most people aren't aware of, and it's called reverse for purchase. You can actually, if you're a senior, of course, it's all about the senior market, can buy a home using a reverse mortgage. So when would that come into play? Okay. Over the last, I don't know, 10 years for sure, we've seen a mass influx of new people into the Central Texas area. And a lot of them are retired people moving closer to their grandchildren from California or from New York or Florida. I'm doing 2 loans right now for seniors. They're seniors and they're still working. So they're able to qualify for a traditional mortgage. But if they weren't working and their income was limited and they sold a home, let's say in California, and they netted $500,000 or whatever, they could come into Austin and either pay cash for a property for $500,000, or they could use a reverse mortgage and buy an $800,000 house with no mortgage payment, because the reverse mortgage would make up the $300,000 difference, as an example. It's not an exact formula, but they could put down their $500,000 and buy a whole lot more house. Okay. So why would they do that? Well, it meets their lifestyle. It meets where they want to live, and the price point may be higher than what they have as far as cash available. Or they could buy a $500,000 home, and as opposed to paying cash for it, they could put down, let's say, $300,000 or $350,000 and keep the balance in the bank. They could put that money in the bank in an escrow account, not an escrow account, but a savings account at 3 or 4 or 5%, gain some interest, and use that side account to pay their tax and insurance every year. So again, they wouldn't have a mortgage payment. They would still buy the $500,000 house, but hold back about $150,000, and they could use that to pay monthly expenses or monthly obligations, which would be tax and insurance. So that would be another option for people who want to buy a home using a reverse mortgage. Okay, there's typically going to be 3 options: to pay cash for a property. They could actually sell their home and rent if they wanted to, but assuming they wanted to buy, they could either pay cash for a property. They could buy more house if they wanted to, using that money, or they could buy the same amount of property and put down less money and hold some money back. So there's all sorts of strategies around reverse mortgages for purchase as well. And I'm going to probably do a show just on that, because it's pretty fascinating. And so in addition to the loan itself, let's say there's also going to be a credit line associated with these loans. A credit line is different than the loan amount. Let's say the loan amount is $100,000, but you may qualify for what they call a line of credit. These loans have a line of credit to them that's very unique in the marketplace. Now, there's also a product out there for anybody, not just seniors, but anybody can qualify for a HELOC. A HELOC is a home equity line of credit, and those serve a lot of needs. I have one on one of my homes, and it's served me well. It's a fixed amount of money. Okay, so it's the same amount. It's kind of like, I hate to use the word credit card, but you can borrow money against it, pay it down, and charge it again. It's a line of credit is what it is. Now, HELOC, reverse mortgage is very similar, except the line of credit grows. My line of credit doesn't grow. It's been $250,000 since the beginnings, which is almost 10 years. We've had it a long time. And it served us well for a variety of reasons, but it's never gone higher. It's not. But if you were to get a reverse mortgage and you had a line of credit for $250 in 10 years, it could be $400,000. It gives you more access to your equity over time, because the line of credit grows at the same interest rate that your loan grows. So there's always a nice spread between what you owe and what you have access to. And you can use it for anything. They don't limit you on what you can use the money for. You could give it to your grandkids. You could help your kids buy a property. You could fix up your home. You could buy a car. You could travel. Whatever you choose to do, it's your money. It's also insured, again, so they can never close it. One of the problems with HELOCs is the markets, if the economy's not good, the banks can close your line of credit. So you don't have any more line of credit. That's part of the option on HELOC. With a reverse mortgage for seniors, they can't close it by law. That's why you pay the insurance. The insurance means that you'll have this forever until you leave the property. And so again, there's advantages to HELOC loans, equity loans. There's advantages to reverse mortgages. So every situation is different. But if you have any questions, give me a call. My number is 512-789-6967. Again, 512-789-6967. And my email is mark@markharrison.com. Reach out and let's talk about how this may or may not work for you. And if it doesn't work, then we'll certainly shoot straight with you on that and maybe give you some options. Finally, let's talk briefly. I've got a few seconds here. Let's talk briefly about what choices do the heirs have if they want to keep the house. Okay, the choices are typically that the loan has to be paid off. They gave you 12 months after the party passes away to pay off the loan. Now, you could refinance if you take title of the property through a probate, through an inheritance. You could refinance the property, or you could buy the property from the estate. Okay, so those would be the two options. But again, title, the property can be willed to somebody. It's not gone. The bank doesn't own it. If there's equity there, then you could take the property and you could sell the home. Okay, within the first year, if you take title, you could sell the property and you take the proceeds just like you would if there was not a reverse mortgage or any kind of mortgage on there. So those are the options for you. Again, hope that was helpful today. And